right, good day. My name is Nedu, I'm the Forex Coach. Today we're looking at a very simple and easy strategy that you can deploy in helping to build your account. You may know this before now, but I'll bring you more insight to it. And that is how to use the market maker strategies to trade the Forex market. All right, so it's important that we know who the market makers are. Those who move, whose actions cause very large, huge volatility in the markets, okay, by reason of their transactions. And these are the major banks, the big banks, institutions, financial institutions. They are the ones called the market makers. They are the liquidity providers. Their activity generates so much volatility in the markets, and we also have people that have been committed to, handling some transaction for them, and these are called the dealers. Okay, in order for them to make a profit, they will have to take you out. The retail trader, so they have to take you out of the markets in order to make profits, right? And they do this, from three simple approaches. They have three simple strategies to do. These we have mastered. We have already identified that their actions make you make some errors as a retail trader or an experienced trader in the market. I'm bringing you this information to help you improve on your trading. All right, we want to induce you to take a trade irrationally by making some moves. You see price making some spikes, and you think that market is moving in that direction. You have an inducement, and the false inducement. The other thing they do is that they create fear, in the markets, and this happens even sometimes through news. And the other thing they do is to take you out of stop loss. Take you out of stop loss. And we've identified a typical daily cycle of the market, and this is caused by the activities of the market makers. So when I identify these cycles, see this typical cycle here. My screen's already been shared. I'm sure you're seeing this. The first is the inducement phase. I have a phase, 4 phases of the market. The first one is the accumulation phase. After the accumulation phase, you have the inducement phase, the trapping phase, and then we have the run phase, 4 phases. And this is the regular cycle in the market. And showing you this, your eyes will be opened. You will see this repeat every day. It's something that repeats, the repetitive cycle in the market. They may not take exactly the form, the drawing I'm showing here, they may not exactly take that form, but most of the times, if you master it, you know which of the phase that this market cycle is on, all right? And the activities of the market makers, these huge financial institutions, okay, the huge banks, okay, the activities cause these cycles to be seen in the charts, all right? So the first phase is the accumulation phase, and this is when the market moves sideways, and this happens a lot of time during the Asian section of the market. All right, you see the market without direction, it ranges this way. All right, and when it's London session, it's AM GMT +1. Okay, you will see a move away from that range. It's either a bullish or bearish. Either that move goes up or down. All right, and that is the trap. That is the inducement. The market makers are making this. They are accumulating contracts here during the Asian section, okay, of the market. And when it's London section, first thing in the morning during the London session, when trading activities resume, you will see these movements, unusual movements in the market. Price will just move in a direction away from that range bound, okay, trading. And this is what we call the inducement phase. I can use I to denote inducement phase. And from this inducement phase, we enter into the trapping phase. The inducement phase can take between 25 and 40 pips away. Some people do trade it Of course, when the market continues, starts to range, consolidates, move without direction, okay, between one level of support and resistance, one thing must happen. There will be a breakout either on the upside or on the downside. This is technically, speaking technically, is what we observe. But there are some activities, and that's why we're giving you this background information. Activities of these major banks that cause all this to happen. Okay? Fine. So this inducement phase can take you, I said, between 25 and 40 pips before you now have the trapping phase. When you get to the trapping phase, it is game over. They induce you to think that the market for that particular currency pair is going to go in that direction for that day. Okay, because that is what every trader seeks to have a bias at the beginning of the market. If they open up the market in the trading day, okay, just want to have a bias. And the direction that the market moves initially from the beginning of the London section seems to set the pace for the day, but most of the times it is a trap. So at this point, several traders are in on the bullish positions. They are in around this area in the inducement phase. Several people have taken trades. A breakout from this range bound structure, people have taken a bullish position around this area they have taken. Now this first pullback means, okay, this is a pullback of this whole bullish impulse. Suddenly the price moves again, giving you something that looks like an M, a double top, whichever term that you can use, but we'll call it the trapping phase. Okay, the trapping phase. At this point, the market has been trapped. Everybody who have entered into these bullish positions have been trapped here. Right? So the next thing you see, price begins to come down. I just want to take you through these phases. So this is the trapping phase. Let's see, this one is the accumulation phase, and usually happens during the Asian section. And this is the trapping phase, game over for all the buyers. And here is the run phase, R. And it is in the run phase that every trader would like to be, want to be in this market. See what this guy did. The accumulated orders here, it fakely induced traders to trade in the bullish direction, trap them here, giving you a double top or an M formation, which suggests that market is not going to go in that direction, and now they will do the main run downwards, and now come back and repeat the same structure again, do another W here, induced in this way. Okay, and here is game over, and you see price move all the way to this point. So we're going to be looking at what happens around these market, daily market structures, and how you can trade them. And that's the reason we're doing this video. Let's look at this chart. You can see these are typical charts, and this region that is shaded in sky blue here is actually the accumulation phase, and this happens during the Asian session in the night. All right, now morning, these are the London session. The London session opens, price spikes up, down, and makes this move up. Many people see, and this is the high of the day and the low of the day. There's a breakout now on the upside, and of course, trading these, you will see these small pin bars here. And studying charts, candlesticks patterns, you understand that these pin bars are really indicative of reduction in the market momentum. Okay, at which you begin to send a reversal. They usually give you sign of reversal. You see the small pin bars, and of course, this is an inverted hammer. The candles are now becoming tiny after this long bullish candle. You can see here. So all the way from here to this point is the inducement phase. And here is that trapping phase that looks like an N. You can see an N. All right, an N. And this is where we are getting ready to make a catch. Is at this point we are ready to take the trade. Now, in taking this trade, you must identify the accumulation phase, okay, the inducement phase. All right, here is the trapping phase. Trapping phase, and it usually gives. This trapping phase can be in different forms. It can be an N, okay, with its chart patterns. It can be head, it can be shoulder, head, and shoulder this way. So it can be an M, a perfect M. It can be a perfect M, and it can be an M that has the upper first leg higher and then the second leg lower. It can be one that is the same height. So whichever way it presents itself, and I said it can be shoulder, head, and shoulder. Just a pattern that signifies market reversal. Okay, and in dealing with this, we use only two time frames: a 1 hour time frame and the 15 minutes time frame. The 1 hour time frame is the main chart where you do this analysis and observe this kind of cycle and structure showing up. And the moment it's confirmed, you move to the 15 minutes time frame in order for you to enter the trade. You follow a certain entry procedures to enter the trade. The second, your attention is more on this second M, the second leg of the M. This second leg of the M. There are a lot of candlesticks, formations, arrangements that you should be looking out for. When you see this structure, it's no bullish. Price looks like it's moving in the bullish direction, but that is the trap. It is the trap. So the second leg of this M, we begin to check some candlesticks formation, and I'm going to show you some of them. At this place, you can see what we call the engulfing candle. This one is the bullish leg, and then the next candle that forms is bearish. It totally engulfs it. This is a bearish candle, and this is the bullish. It totally engulfs it at this particular point. And of course, know that you are looking out for these in the 15 minutes time frame at this second leg of the structure, the second leg of the structure. You are doing that, and this particular point may not just give you this kind of structure when you are looking at it from the 1 hour into the 15 minutes time frame. It can be something like this, like an M exactly here. All right, so you are looking for things. You're looking for candlesticks that will suggest to you that it is right for you to enter the trade, and one of them is this. Another one can be a gravestone dodging, something like this. Okay, another can be what we call the railway track or railroad track. You see two equal candles. The first is bullish and the second one is bearish. They are the same height. Okay, this one is bullish, this one is bearish. It also signals reversal. The other one is a cow. That is 4 candles. You see 4 candles, one bullish, one bearish. You see another one, they are almost like the same size. Another one bullish, this is bearish here. Okay, another bullish, another bearish. If 4 of them form each 15 minutes. This is another sign of price reversal. There are several of them. You can see also an inverted hammer like this. From here, you can see the hanging man around this area. You can see some small candles, copying bars. They are all signs of reversal. The moment you see them, you now begin to take some precautions. And of course, you are not going to depend only on one setup, one market entry setup to take your trading decision. In our model for this trading strategy, we make use of 5 moving averages, and there is exponential moving average. One of them, the 5 days, 13 days, 50 days, 200 and 800 days. And each of these moving averages play a vital role. Okay, for an aggressive entry on this point, you will see the moment you see the 13-day moving average cross the 5-day moving average around here, so you can immediately take a trade, an entry here at this point. All right, let me clean all these. That's an aggressive entry from that high. Okay, that candle, reversal candle structure has formed, and at the same time you see the 13-day exponential moving average cross over the 5-day exponential moving average exactly at the second leg of that M structure or shoulder head and shoulder structure. You are seeing it there. It's an aggressive entry. So if you enter the market somewhere at this point, at this crossover, your stop loss should be some 5 pips above the high of this structure. We call this peak formation high. Peak formation high. Okay, in the case of the bullish inducement, peak formation high. All right, this peak formation high means, it also means a sign of reversal if you are dealing with a chart pattern. But for this strategy, we call it peak formation high. And when peak formation high forms, you shouldn't be in a haste to take a trade. There are certain things to confirm if this peak formation high is genuine or not, because you can have some of them fake peak formation high. And one of the things to check is when the price has closed, when this structure has formed and price has closed below the 50-day moving average, exponential moving average. And in this case, what this sky blue line here is the 50-day exponential moving average. The white one is the 200-day exponential moving average. All right. In this particular drawing, we don't have the 13 and the 5. All right. I've told you the use of those two, 13 and 5-day exponential moving average. You want to be an aggressive trader, you want to enter to get more. Whenever this structure has formed, you have seen your reversal candlesticks patterns set up there. The 13-day moving average crosses over the 50-day moving average. You are getting ready to enter your trade. And when you enter somewhere here, above, some pips above the peak formation high, you put your stop loss in. Your stop loss. And you see the market move down. But peak formation high is confirmed to be genuine when the price has closed below the 50-day moving average, as you can see here. So price has closed below the 50-day moving average. This is the 50-day moving average. Price closes. That is the condition that will make us say that this peak formation high has been locked, or it is confirmed to be genuine, and market price will not go again in the bullish direction. So when this happens, it's not ready yet for it to take a trade. When the price has closed below the 50-day moving average, it can move all the way down to this point. You can locate a second entry at the crossover of the 13-day moving average and the 50-day moving average, and that can happen anywhere around this region. So you can take this as a second opportunity to enter a trade. So you see, those that entered here, they've accumulated up to 140 pips from this level to this point. Okay, this whole thing is not finished, it's not done yet. There's still more opportunity coming. Look, see what happens. When price has moved that, you know, you can call it the strike zone now, price has moved this way down, you accumulated 140 pips. The next thing is to begin to watch for a retracement. Price will immediately retrace, and that's where you bring your Fibonacci retracement tool. From this high, you drag it from this high to this low and see the levels of retracement. And the levels of retracement is the one that will form around the 50-day exponential moving average. That 50-day exponential moving average plays a very big role. And you don't just use it as a guide, you know, to take trading decisions. No, you have to combine it with a lot of things. Okay, now a good trade is a trade that has a lot of complementary factors, and we call it high probability trade. So at this point, the market price will retrace back to the 50. It will retrace back to the 50, and this is what we call the safety trade. This is the surest trade to take in this whole cycle. All right, when price has moved back to the 50, you are using two things: your Fibonacci retracement. You drag it from up to bottom here, and you see the various levels. The retracement, the most reversal retracement levels is the 50% or 61.8%, and this most times will coincide with the 50-day exponential moving average around this area. So when it gets here, oh, this is good. You're now getting ready to take another trade. Okay, you still follow the same procedure. On a 15-minute time frame, you will likely see another information here. Another information, and you are looking for some candlestick formations around the second leg of the M that will suggest you to enter the market. And when you do see that, okay, also above here, you can put a stop loss above the first leg, 5 pips above the first leg as your stop loss, and then anywhere around here to enter the trade. Another thing that can give you an entry here is when you can see that this is why the 200-day exponential moving average, it has crossed above the 50 EMA. So you're coming down again to take this trade. And this is how this cycle will continue. I need to show you exactly how these cycles play out. This is how it plays out here. It will give you an accumulation phase. This is that inducement phase. All right. You have the trapping phase, accumulation here. This is the inducement, trapping. All right. It will now do this. It will do 1, 2, 3, 4, and 5. All right, and this can happen between this trapping phase until this market has fallen in 5 waves, following the PNF Elliott, wave formations in 5. It can happen between 2 days and 5 days. Between 2 trading days and 5 trading days for this to happen. All right, so this is the first point you are entering the trade, the aggressive entry. Price has closed below the 50-day exponential moving average and comes back to retest it, which we call safety trade. Okay, safety trade is a cycle. It pulls, gives you another big move down. All right, and returns. This time around, it can return to either 50. The third one can return to either 50-day moving average, or it can return to 200-day moving average. And I tell you, this happens each day. It cannot. These pullbacks cannot happen in one day. This will enter into another day. All right. So this is the position. This position now is what we call the second chance. Second chance. Market gives you the second chance to enter, because this is the first one, safety trade, and here is the second chance, and it pulls all the way down here. You would have traded 1, 2, and 3. Made quite a lot of money. Can accumulate up to 300 pips on this if you enter very early. And now when this happens, see the market form a W structure. Okay, a W structure is going to begin the new phase. So this W structure will pull off again. Of course, you will have it break the 50. The moment it breaks the 50-day moving average, this 50-day moving average here. Okay, 50-day moving average, and comes back to retest it. When you retest it, you pull your Fibonacci retracement tool from this point to this area, from here to here, and around this 50-day moving average will be either 50 level of retracement or 61.8 level of retracement. So you just get ready to take a trade. Of course, all this is happening in the 1 hour time frame. When this happens in 1 hour time frame, you go down to your 15 minutes time frame, where you will see the W formation again. Most times you see price making this the W formation. You are looking for the top leg, look for some candlesticks formation that will suggest market reversal. Of course, those candlesticks formation that will suggest that, and then you wait for a crossover between the 50 and the 13 and 50. 13-day moving average and 50-day moving average, the crossover around here. So at this place, you are pulling your string again, price will push all the way up. While the 50-day moving average is correcting, here is your safety trade. So at this point, it gives you a second chance. Return to this level, push back up, then do another end. This is how the market does almost on daily basis. It's a cycle, and this cycle is controlled by the actions of the market makers. So this way you can follow and know what is inducement, a fake breakout, what's it's called sometimes fake breakout, and inducement, or a deceptive move of the market to take you unawares. But if you follow these simple rules that we have identified here, making use of those moving averages as guys are going to enter the market and when to not to enter the market, you'll be trading very safely and profitably. Right? If this video helps you, like it to hit the like and subscribe to the channel so that people can have the opportunity of seeing this video and then taking advantage of this content. Thank you so much for following and watching this video. We'll see you again in the next video. Bye-bye.